Welcome, everyone. Good evening from wherever you are logging in from. Today, I want to do something a little different. Most of the time when we do webinars, it's focused on like why you should invest, but I want to kind of teach you a little bit differently. Something nobody talks about which is what happens after you invest in a real estate syndication. If you're here, if you're listening, you understand what that means. And so sometimes real estate feels like this black box, right? You just wire this money, you get some emails, and then you don't know what happens next. You don't know where your money's going, what's actually happening to your investment, what you should expect the first month versus the third year, all of that stuff, right? That's what we're going to talk about. And we're going to use Park at Arlington, which is our current deal, to kind of help you walk through and think through that. It's closing in the next 2 to 3 weeks. And I thought, what better way to educate our community than to pull back the curtain completely and show us kind of like how the entire life cycle of a real estate syndication actually happens. And we're going to use this deal as an example. So my goal is that by the end of today, you'll understand exactly what happens from the moment that you wire your funds to the moment that you get your first and then your final distribution when we sell. So my slides are usually kind of empty, but this time around, they're a little bit more wordy, but that's because there's a lot going on. So feel free to take screenshots. Feel free to ask questions. You probably won't get everything this first go around. And because I have a lot of information, I'm going to speak a little fast, but maybe you can slow it down, watch it a second time, whatever you need to get all this information in. But more than anything, please ask me questions. I'll come back to all the questions at the end, and then we can take it from there. As always, right, this information that I'm giving to you, it's exclusively for you. As accomplished professionals, you understand, the power of due diligence. So listen, take notes, ask questions, and then go from there. Okay, so it's called, passive real estate investing, but what does that really mean, right? You wire the money, you get these quarterly distributions. Maybe you get a K1, at some point you get these a tax document. You're gonna get monthly updates, and then that's it, right? And sometimes you kind of just you're thinking or you're wondering, what's actually happening to my money right now? Like, what is it doing? Who's doing what? What does asset management mean in real life? Should I be concerned? Should I be patient? Did I miss a distribution? What does success really look like on a month-to-month basis? And these are all the questions that I've heard from our investors. And these are some of the questions I asked when I was first investing. And so I want to kind of pull back the curtain and then just help you answer it. But I'm going to do it kind of walking you through from step 1 to step 5, how it goes from day 1 when we close and we sell, when we close and we buy, to like year 5 when we sell. And I want to break it down into 5 distinct phases. And phase 1 is kind of capital deployment. So this looks like the first, from day 0 to maybe 2 months where, we've closed the acquisition, we're transferring ownership, we're setting up operations. That's kind of those first 2 months, right? And then phase 2 is like stabilization. So this is like month 3, month 12. We're going to start implementing, right? So all the things that we told you in that beautiful business plan and the perfect deal deck that we're like, go look at it, go listen to it, all those things that we put in there, right? We're going to start implementing them. So think our managing systems, we're going to address like any deferred maintenance. So anything that the sellers maybe didn't do that we needed to do. We're going to look at that. And then the rest is just kind of getting into the flow of operations. That's kind of the phase 2, which is the early stabilization phase. And then phase 3 is like value creation. I think this is kind of my favorite. This takes a little bit of time. So sometimes we start this very quickly, and sometimes we kind of wait to get the operations in line and then start. So like year 1 to year 3, this is where we really start executing the business plan. The things that we said we're going to do, this is when we start doing it. So we're doing all the improvements, any way to optimize revenue, we're going in to do that. If we said we're going to renovate 30% of the units, we start doing that year 1. And so like any capital improvements, again, like any outside curb appeal, all the things that we said, all of that in the business plan, we start really attacking it beginning of year 1. So this is kind of where all the renovations happen. And then phase 4 is, think about it like the harvest. So this is like year 3 to 5. This is where now we're in steady cash flow mode. Things are going well. Income is coming in. Expenses are going out, are going out. Operations are doing well. We're paying down debt. And then this is the time that we start thinking, okay, when are we going to exit this deal, right? We said we're going to hold it for 5 years. Our loan is maybe for 5 years. So like now we're thinking, as we're reaping the benefits, we're also thinking about the right time to exit and the right time to sell. And then phase 5 is kind of the exit, right? So that's typically year 5 and on, depending on what the business plan did, what, the operators tell you that how long they're going to hold it for. So, but that last year or last year and a half is really evaluating the market, right? Like, are we ready to sell? And then executing the sale, distributing all the distributions plus the profit. And then like kind of realizing all your full return. So that's what the whole phase, the 5 phase looks like. I'm going to break it down. This is where I told you, take notes, kind of just like take screenshots, listen, ask questions. But I think this is really important to understand. Again, right? Sometimes as passive investors, you just put money, but you don't know where it's going, what it's going to. And so I thought it was important for us to break it down, because this is your hard-earned income. This is important. So let's break down the phases. Remember, the first one was like capital deployment. So this is like the first 60 days, right? This is where it's maybe a little intense, because the closing is happening. So like all the investors have wired their money. We've moved it to escrow. We're executing on the title. We're recording the deed. We're finalizing the loan assumption. All our insurance policies are in line. We, at this point, right, when it's all said and done, we physically receive the keys and we get access to the property. And, like our property management team is like on site in their cars, ready to take over as soon as we sign that deed. So that's what's happening, right? That's like day 0. And then all of that kind of starts to transpire over the next 60 days. And then I would say that the weeks leading up to that, right, it's introducing new ownership to the residents, to the on-site team. We've already done this in due diligence, but it's really going, reviewing all those vendor contracts again, making sure, okay, what are we keeping? What are we letting go of? And this is like when now it's ours, right? Now it's ours. We own it. We're operating it. And that starts at day 0. And the biggest thing in these early days is to assess like what do we need right now? What are the immediate things that need to get done for us to continue to manage it well? And I would say second month is like foundation, right? So all our new systems, right? So we are leaving whatever the old systems they use. We don't necessarily bring that in. We use our own system, our property management team. We trust them, all the systems that they use, we bring it into the new property. So, and this is where we start setting up like all our financial reporting. So like all the financials you get, right? It's in these early phases, these early months that we start setting it up. And then like all our maintenance protocols, making sure that we stay ahead of that, all of that. And then like that second month, we start thinking about our residents communication. So like how often we're talking to them, how often we're talking to investors, all of that is happening. And so now that's kind of on the property side. For an investor, what does the first 2 months look like, right? After we close, you get an email saying, congratulations, welcome. We've partnered with you. We're excited. You already have access into our secure portal, right? So you can go in there, see all the stuff. You get an introduction to the property management team, and you actually, over the next maybe few months, you meet the whole team. You get to know them as part of our newsletter. So the month 2, like you get the first official monthly update. You'll see the first financials. As soon as we can get like full financials after we take over, you get access to that. You'll see property videos, you see property pictures, and you'll kind of get an overview of like what's going to be expected in the next 3 months. So all of that is going to be in the monthly newsletter. You will not receive distributions until that will start Q2, which would be like after a first full quarter of financials. When we stabilize cash flow, when we have all the systems going, then you'll start getting distributions. And then you're not going to get your K1, which is a tax document, until year end. So that's kind of what that looks like for you as an investor in that first phase. So then phase two is kind of stabilization. I told you this is like 3 to 12 months. This is kind of where we are laying the foundation for long-term performance. These months matter a lot. And so when I think about kind of the breakdown again is operations, financials, leasing, physical property. So that's how we think about what goes on in these, that kind of first year. Our goal from an operations standpoint is make sure that we optimize maintenance. We need to create schedules so we stay on top of like maintenance, right? We don't want to fall behind and then like have things that kind of are deferred. We also want to make sure that we're talking to our residents so they know new management has come. These are our goals. This is what we hope to do. And then from a financial standpoint, this is just like really more on the metrics side, also, but another important thing on the finance side, these early months is to figure out where we can decrease expenses. So, we underwrote the deal, we made assumptions, and this is where we start making sure that that's in line with what we came up with. So where are we maybe spending too much? Where do we need to reduce some of the expenses? And this is where we need to start thinking about like rent collection. So how do we optimize that? And then making sure that we have reserves for a rainy day if something goes wrong. And then from a leasing standpoint, right, we just need to see where we are, what we're collecting, making sure like if there's bad debt, we need to go after it pretty aggressively. And then the goal is like we want to decrease turnover. So like how many lease renewals can we have, right? Instead of always looking for new tenants, our goal in that first year is, okay, see what's working. How can we keep our repeat tenants, because those are the most loyal. And then thinking about like if vacancy is high, how do we start decreasing it from a marketing standpoint? So that's what kind of that first year looks like. And then again, the physical property is curb appeal, making sure the outside looks pretty. Any deferred maintenance, that's key. We want to go after it. So things that were left behind, we want to make sure that we're targeting that. And so that's what that looks like from kind of a operational standpoint, from a stabilization standpoint. So this slide is kind of busy, but I think it's really important, again, as an investor, what do you expect? And that's like the least that we should be able to deliver to you, right? So every month, you're going to get monthly updates. And that includes like what occupancy is, what rents were collected. You get financials on a monthly basis. You see maintenance. When we start doing renovations, you see that. So as we progress along our business plan, that is what you should expect in the monthly update. Again, right, that first, the stabilization period, you're going to start getting distributions. And like I said, this is probably second quarter and, after we close. So expect that, right? We hound you for to make sure that your bank account information is on so that we can start doing direct deposits. And then like I said, annually, you're going to get that K1, which is you're going to use to file your taxes. You always have access to the portal. So 24/7 access, view financial statements, download distributions, all of that stuff is accessible to you on the portal. And we'll give you access to get on the portal towards the end of the presentation. But then again, so now we're on to phase three. I said we would go pretty fast, but important. This is where value, this is like the meat and potatoes, the year 1 to year 3. This is where we execute the business plan. And the goal, right, is to think about it in 4 different like value creation strategies. So what are we doing? The first one is revenue. We got to optimize revenue. So now, we need to start thinking about rent increase, but in line with where the market is, right? So organic rent growth, how are we increasing rent? And then as we start doing renovations, right, how do we start implementing that from a rent increase standpoint? And then another goal when you're trying to optimize revenue, I spoke about that earlier, is to reduce turnover. So you don't want people leaving to try to get new tenants. You want to keep the tenants that you already have. And then another thing, when you think about a revenue, from a revenue optimization, how can we get other income? So like, how can we start implementing pet fees? If there's parking, like if there's covered parking, or if there's storages on the site, right? How can we pay? How can we bring value to our residents and in turn, charge them for that? So thinking about that. And then as you think about optimizing revenue, concessions. So like when we, if at some point vacancy was high where we had to give like 1 month free or 2 months free or something, right? Or 50% off the first month. How do we start decreasing that as we optimize revenue? So those are the things that you need to be thinking about. And then from an expense standpoint, right? We need to look at all the vendor contracts. Like, are we getting charged too much? Are we getting multiple bids? Thinking thinking about reducing insurance costs. That's also something to think about. Optimizing staff, right? Having the right number of staff for the right number of tenants. That's also important. And again, making sure, I talked about earlier, but even if in like phase 2, even if in those first 3 to 12 months, right, we were looking at where we could decrease expenses, we're still doing that as we progress. So it's not something that we did only at that phase and we stopped. It's something that we do. We're always looking at, right, weekly, monthly basis. And it's something that we talked about. And then physical improvements, right? This is where we start renovating. For the park at Arlington, we're going to renovate about 33% of the units. So, and we do this only when, a unit becomes available. So we don't kick tenants out. So we look at renovating maybe like 4 to 6. We don't renovate like large numbers. It's really as the units become available. So it doesn't disrupt kind of resident flow. And you might not even know that it's happening. But those are the physical improvements in that year 1 to 3, because as we do renovations on the units, right, we're able to increase rents for the new tenants that are coming on. And then, common area, curb appeal, if we need to like upgrade the office, if we need to think about, like upgrading the gym, like, or, even something like the physical improvements, for the park. One of the things we're doing is washer and dryer in the unit. So all of that is happening year 1 to 3. And then another thing that people don't think about, but is resident experience. So making sure we're communicating with them. We love monthly community events. Like this is a big deal. So think like Easter egg hunt, if there are kids on the property, or think like, Valentine's Day, something, maybe like cupcakes or something. We always try to think of every month, have a theme, Halloween, Thanksgiving, we give out turkeys. So like just ways to get the residents to know that like we care about them more than just collecting rent every month. So that's something that we pride ourselves in. And as an investor, like you'll get to see that. You'll see what is happening on the property. And if you get to, if you want to visit, you can absolutely go visit. Again, you're part owner of this, but that's something that we kind of pride ourselves in, and the residents love it. So, and then this one, so as as an investor, what should you be expecting, right? So again, right, I said at this point, you should be having the monthly updates, your distributions are coming in. And then like those monthly updates, you're going to see how the net operating income is doing. So how the property is really doing, how the business is doing. You'll see occupancy, you'll see kind of renovation progress, market conditions. So as we do it on the property, you as an investor, you're getting the updates. Again, you're getting quarterly distributions. And then at the end of the year, you get the full financial review. And then you get your taxes, you get your K1. So that's kind of phase 3. That's year 1 to 3. And then phase 4 is kind of like the harvest. So this is typically 3rd to year 5 and kind of beyond, just depending. This is really when kind of we're just going, right? We're doing exactly what we said we're going to be doing. We're implementing the business plan, we're executing on it, and we're really just focused on returns, making sure that, again, operation is stabilized, the property is performing well. If there's something that's not going well, let's say, vacancy is higher, then we go back and say, okay, what do we need to do? Are we upping marketing dollars? We may be bringing back a little bit of concessions just to get the numbers back up. Like, what do we need to do? We're looking at the systems, we're looking at processes, whatever it is that needs improvement. This is just, again, right, this is the day-to-day. We're meeting, as operators, we're meeting with the property management team. So the regional property management team, we're meeting with the on-site team. So we know exactly what's going on, right? And that these years, right, our goal again is to make sure that our investors, we're maximizing distributions for our investors, making sure everything is stable. But also what we're doing at this time is really monitoring the market, right? So these years 3 to 5, we've probably gone and talked to the broker, and I'll talk about that when we talk about selling. But we get something called the broker opinion of value. So it's like, okay, what is the market saying right now, right? Is this the right time to start thinking about exiting? So these are the times that those strategic decisions we're making, like, are we going to continue to hold for cash flows? Again, is the market conditions, are they favorable for us to start thinking about selling? If it isn't, is this the time to refinance and return some capital to investors, while we keep the property? Those are the decisions that we're making in kind of year 3 to 5. And that decision is kind of on a weekly basis, so we're looking, okay, how are things going? And then if we kind of have a plan, maybe we reassess next quarter to see where we're going. So that's what happens kind of year 3 to 5, but decisions are happening at this time. And then phase 5 is the exit, right? This is how and when we're going to sell. So that the exact time is kind of arbitrary, right? Because we're looking at multiple factors. And this is important for you to know. So like, what is the market saying right now? Is it the right time to sell? What's happening with interest rates? How strong is the market, right? This is something as an investor you should ask the operator, right? We don't pick markets just for today when we're buying. We also make sure that the market will be, on an upward path and upward trajectory when we want to sell, because your buyers want to be in a growth market. So that's something that we're thinking about. How strong is the market when we want to buy? How strong is the market when we're planning on selling? And we're also looking at comps. So looking at what's sold in the area, how much did it sell for, what we think we're going to get, all of that. We're taking all of that into consideration. And then, at the end of the thing, the goal is always like, what are we doing? Like, how are we targeting investors? So like that 5-year hold period, have we achieved what we said we're going to do? And then also even thinking about like, do we have another property that investors can also invest into? Again, that's something that we're thinking about. And then the actual sale process is going to take anywhere from 6 to 9 months. But that is like, again, what broker are we going to work with? We usually work with a broker who sold us the property. Again, looking at the market, all of those things, making sure the property is ready, like also doing, buyer tours, doing due diligence, all of that is going to take maybe 6 to 9 months before we finally sell and return distribution to investors plus the profit. So now what actually happens when we sell, right? This is from a kind of an investor standpoint. You're going to get, the first thing we're going to do is we're going to pay off the loan balance. We're going to cover all the closing costs, all the fees, and then we're going to return investor capital. And then we're going to distribute your profits. That's exactly what it looks like. And then you'll receive kind of your final tax document that's showing everything. So for instance, right, with the park at Arlington, and I said I would kind of use that as an example. If you invested 100,000, right, you're going to get that 100,000 back, plus all the distributions you've been getting since Q2 of year 1, plus profit share at the end, which is approximately around 183,000. And that looks like 17%, kind of on an annual basis that you were making on that initial investment. And so at this point, when you get the money back, then you decide what to do. Do you want to take it? Do you want to invest in another deal, deploy the cash elsewhere? Again, all of these things are just kind of things that I want you to think about. So now I've told you how the process from phase 1 to 5, from day 0 to when we sell. But I want to also talk to you about risk, because this is real, right? And I would be doing you a disservice if I didn't address risks. But I want you to know so that you can make an informed decision. So, we could have market risk. So think about like if we had another recession, right? Also thinking about like interest rates, kind of what happened a few years ago, that when interest rates spiked, it could make it harder to sell or to refinance. And so again, we're constantly evaluating the market, but that's something to think about, right? From a property specific risk, right? We could have major kind of expenditures that we didn't expect. Like there could be a fire or natural disaster, right? Like with this storm, can't remember the storm's name, but that just came this past weekend, right? If a tree froze and broke, hit a property, all of that stuff is things that could happen. But that's again why we carry insurance. And so some of those things we don't have to, we can sleep easy at night because we know we have insurance. But how do we mitigate some of these risks, right? Because it's important. We underwrite very conservatively, and we definitely have like margin for error, like because things happen. The property insurance is a really big deal. Having experienced property management team, like you standing firm on like what we know, our experience, and kind of all the properties that we've managed, all of that, looking at track record, always having operating reserves. So making sure that you have money that we set aside if something does happen. Again, real estate is not risk-free, but knowing the risk early on and being able to make sure that you have, everything in place kind of to mitigate some of those risks, I think is very helpful. And you also need very strong fundamentals and then experienced managers and operators to manage it. So that's just thinking about, I want to make sure that I talk about the risks. So kind of, I want to bring this full circle because I said we would talk about Park at Arlington. And we are closing this deal within the next 2 to 3 weeks. We are about 92% committed, with the final like 2 to 3 million remaining. And we're not going to do an extension after that period closes. But this is what I want you to kind of understand. And like I said, I gave you a lot to kind of chew on, to digest, but I really did want you to understand what happens from day zero after we close until we sell, right? And kind of what happens during those 5 phases, what you'll receive, when, how we're going to increase the value, all of those things, what success looks like in each phase, or on a yearly basis, on a monthly basis, on a quarterly basis, and then kind of thinking and helping you understand the risks and how we kind of plan to mitigate some of those risks. But the opportunity, right? It's not about pressure. It's really just giving you a chance to be part of this specific deal before we close it, right? We don't have another deal lined up, but we're always reviewing. We're always looking at deals. But what I do know is going to be a different deal, right? It's going to be a different asset, maybe in a different market with a different structure. So that's also something to think about. And I'll tell you kind of the meat and potatoes of the Park at Arlington, so you'll be able to fully understand this deal. But my goal today was just to educate you, and then give you the opportunity if it is the right one for you. And so if you understand the journey, right, and it aligns with your goals, then great, then jump in. But if it doesn't, then at least you have clarity on what this looks like, because sometimes investors don't understand, like what is real estate syndication? What does it work? What is it? How does it work? When we buy a property, what does that look like? So being able to kind of explain all of that, I think is very important. So after talking about all of that, I want to give you some just quick facts about the Park at Arlington. And you might have listened up until this part and you're like, okay, I'm ready to jump in. I want to be part of this deal, right? So our team is going to put up a link and it'll take you to a secure portal. Click on it, create an account, and then one of a team member or I will reach out to you within the next 24 hours and take it from there. But you've heard about the Park at Arlington. It's probably not the first time, but it's 188 units and it's in Covington, Georgia. And we're buying it for $33 million. And this is kind of the big things that we're thinking about. Our thesis is that, Rivian's $5 billion plant is coming, and they're set to, it's not like an idea, it is already happening. And it's set to bring about 7,500 jobs starting this year, right? And then Meta is already there. That data center is already in place and it's bringing thousands more jobs. And so that looks like maybe close to 10,000 or more that need housing. And so there's limited supply, right? So we are positioned perfectly for the incoming demand that's happening. Housing is a basic human need. And so sometimes they might not have the opportunity to buy. And so rental is the next best thing. And so we are positioned right there for that. The structure, we're assuming a loan at 3.5%. You will not get that today in today's market. And that is a huge advantage for us year one, day zero. And we also went in, with very conservative underwriting, and that works, right? And if you actually want access to our underwriting, pages and pages of Excel, I will definitely give you access to that so that you can see kind of some of the assumptions we make, how we think about this is very important. And then the returns, I kind of talked to you a little bit about that, but yearly basis, you're going to be making around 17%. And that looks like, 1.8x what your initial investment is. You're going to be getting quarterly distributions starting second quarter of the first year we invest. So this year, and then plan to hold it for the next 5 years. So that's kind of the big thesis and plan behind what we're doing. Again, right? This is a very strong submarket that we're buying in, and that's like, from right outside of Atlanta. And we've seen continued growth, we've seen expansion that's moving east, and so we are able to get all of that expansion. But again, right, one of the things that we look for when we're looking at a property is making sure that there's job growth, making sure that the population is growing, and making sure that like the supply is limited so that we can take in all the demand that's coming in. But that's exactly what we look for in the markets that we're going after. And Covington really just like fits that to the T. So what does this kind of translate to you as an investor? Like as you're sitting there, you're thinking, okay, what does this mean, right? Based on our conservative underwriting, and it's very conservative, right? It looks like we're going to be projecting, again, 17% on an annual basis over the 5 years. And that's kind of what that looks like. And if you, based on kind of all the things we talked about, all the EV plant coming in, the meta, the jobs, the population growth, right? We are going to see about a 15 to 25% growth in the value of the property while we hold a deal. So it's really neat. And all of that is kind of backed by data and what's happening today. Okay, so next steps for those of you who are ready to jump in, right? The link to the secure portal is going to appear on the screen. I think it's already on the screen, but if this feels like the right fit for you, kind of based on everything that you've learned today, then take the next steps, right? Get into the portal. You have access to kind of review all the materials. So the investment summary, the offering memorandum, so the nice way to just say the deal deck, all the financial projections, the market analysis, how we think, how we make decisions. You get access to all of that. And I want to make sure that you have that. And again, if you want the actual underwriting, please feel free to reach out to one of our team members or me, and we'll send that to you. But then after that, schedule a call with me or one of our team members. And really, the idea behind that is to make sure that we are aligned. Like this is the right investment opportunity for you, be able to answer any questions that you have and kind of review your personal situation. And then after that is just to complete the investment paperwork, which is all on the portal. You will review the subscription agreement. So the private placement memorandum that was created by our legal team, you will read that, review that. We will verify your accreditation status and all the banking instructions. And then the last step is to wire the funds. And so you already know the deadline. We talked about it. After we get all the money, they go into escrow, which means they're protected, right? And then you'll get confirmation. So again, the link is going to be on the screen, and then you'll get you can go into the portal, get access to that. Again, from a time-wise standpoint, right? We're closing in the next few weeks. So if you're interested, I would say move quickly, but thoughtfully, schedule a call. And then if you're not ready, right, that's completely okay. Wait for the next opportunity. More than anything, I want to make sure that it aligns with your goals, where you are, the growth that you want. I think that I know all of that is more important than jumping into the deal today. So I wanted to talk about this. I get this question asked a lot, right? You can always invest with cash. And the question is, well, what options do I have to invest? You can always invest with cash, but you can also use an IRA or an old 401k. And you can convert that into a self-directed IRA. We have a custodian that we can connect you with that will walk you through every step and get that if that's how you want to invest. But you have that option. And that's the thing. I want to make sure that as our investors, our community, you have access to all the information and then take it from there. So I want to leave you with this final thought. And then I want to open it up for questions if you have any questions. But the best investments you make are the ones that are informed, right? You can make a decision and you can gamble and guess, and maybe you'll be successful. But sometimes when you make the right decision, it's the ones that you have information and you have knowledge behind. And that was kind of my heart today, right? It's to make sure that you understand the full life cycle of a syndication, what to expect from day zero till year five, how we create value, how it works, what an investor experience should look like, the expectations that you have, and then talking about risks, right? Because it's not always going to be rosy. Things could happen, markets could change and shift. And so knowing all of that is very important before you make the decision. But I think this is what's valuable, right? Take that knowledge and then use it to make a better decision about park at Arlington. Yes, but you can also use it to evaluate kind of any future real estate opportunity that you might have. It also helps you to ask better questions to, anybody you want to partner with, any operator that you're thinking about investing with. And more than that, more than anything, right? I want to show you what full transparency looks like, what is expected of you as an investor, and what's expected of me as an operator managing this deal. So my commitment is that, whether you invest in Park at Arlington or not, that you are a more educated investor. I think that is the most important thing. And that knowledge, right, has value beyond this one single deal. So I want you to take that with you more than anything. But this is what we're offering here, right? This is what the Park at Arlington represents. And that's what Phoenix Capital is built. And it's to deliver, just returns and deals to professionals just like you. So I want to say thank you for being here. I'm available after this webinar. Set up a call. We can kind of, again, figure out the right opportunity for you, and then, follow up questions. So I definitely look forward to continuing this conversation with those who want to explore this opportunity further. So I'll say thank you. And I'll jump into questions. If anybody has any questions, please feel free to toss them in the chat. And then if you want to connect with me, this is the perfect way to do it. So we're on all social media platforms. On the website, you get access to schedule a call, and then feel free to also, and also get on the portal, and then we'll reach out to you that way. So again, thank you so much. The question is, perfect. Thank you. What progress has already happened before closing that investors should be encouraged by? Oh, this is a great question. So I will say this: when we underwrote, the first initial assumptions that we made, we went a little bit, we were a little bit more conservative on kind of the amount that we were going to spend on renovations. But after we actually went and we did due diligence, we realized that we projected a lot higher. And so some of those costs are going to come down, and that's also going to be beneficial for investors. So that money is coming back to our investors. And then also some of our insurance numbers, again, were high, but we wanted to be conservative in our numbers. And so it's really fun to get quotes back, and they're lower than we projected. So all of that is already kind of making the deal look significantly better. And as an investor, you're going to benefit from that. So thank you for asking that question. Someone said, if I invest $25,000, what's the payback period, or can I continue to reinvest? It's the same thing. So again, right, the investment period is 5 years. And so that deal, so you are committed into the deal for 5 years. And then the payback period, you're going to be getting distributions every quarter, starting second quarter of year one up until close. And at that point, you will get return of your capital plus profit. And then you can decide if you want to reinvest it, maybe in another opportunity. But the distributions that you get, those you cannot reinvest them into the deal. You get to keep them. So yes, but at the end of the deal, when you get return of your capital and you get profit share, you can decide if you want to invest that into another property, or if you want to take it and do something else with it, or just take it and enjoy it. All of those are on the table. Wonderful. Those are great questions. If anybody has any last minute questions, please feel free to toss it in the chat. And then Yes. Okay. I don't think there are any other questions. I want to say thank you so much for your time. Thank you so much for joining. And again, if you want to get on the portal, you can, and then we will reach out to you. If you want to, connect with us on social media, if you want to jump on a call, you have access to all of that. But on that note, I want to say thank you so much for your time and have a wonderful evening. Welcome, everyone. Good evening from wherever you are logging in from. Today, I want to do something a little different. Most of the time when we do webinars, it's focused on like why you should invest, but I want to kind of teach you a little bit differently. Something nobody talks about which is what happens after you invest in a real estate syndication. If you're here, if you're listening, you understand what that means. And so sometimes real estate feels like this black box, right? You just wire this money, you get some emails, and then you don't know what happens next. You don't know where your money's going, what's actually happening to your investment, what you should expect the first month versus the third year, all of that stuff, right? That's what we're going to talk about. And we're going to use Park at Arlington, which is our current deal, to kind of help you walk through and think through that. It's closing in the next 2 to 3 weeks. And I thought, what better way to educate our community than to pull back the curtain completely and show us kind of like how the entire life cycle of a real estate syndication actually happens. And we're going to use this deal as an example. So my goal is that by the end of today, you understand exactly what happens from the moment that you wire your funds to the moment that